February 2nd, 2026, marks a watershed moment in the history of money. It is not just the start of a new trading week. It is the beginning of a new regime. While you were sleeping, while you were processing the shock of Friday's crash, the rules of the game were rewritten. On January 30th, we witnessed the 30-minute crime scene. A liquidation event so violent it erased nearly $6 trillion of paper wealth in half an hour. Silver collapsed from $121 to $78. Gold shed $600. But that was just the demolition. Today is the restructuring. We are now operating in a world defined by the war shockwave, a CME margin trap, and a physical divergence that has shattered the illusion of a unified global price for precious metals. I am the financial coin historian. Today, we are going to dissect the anatomy of this reset. We are going to show you why the price on your screen is a lie, why the physical metal in your hand is the only truth left, and why the institutions used this weekend to lock the exit door behind them. This is not a drill. The leverage has been flushed, the debt spiral in Japan is accelerating, and the industrial shortage of silver has not gone away. It has just been repriced. Let's open the ledger. To understand where we are today, we must first conduct a forensic autopsy of Friday afternoon. Market veterans are calling it the 30-minute crime scene. It happened in the final window of the trading week when liquidity is thinnest and anxiety is highest. Gold futures were hovering near their all-time high of $5,600. Silver was parabolic, trading above $120. The sentiment was euphoric. Retail traders believed the breakout was unstoppable, and then the trapdoor opened. At exactly 2 p.m. Eastern Standard Time, a massive wave of sell orders hit the futures market. These were not small retail sells. These were institutional block orders designed to overwhelm the bid stack. Algorithms programmed to detect momentum shifts instantly flipped from buy to sell. In the span of 30 minutes, silver plummeted 31.4%. Gold dropped 11.4%. This was the largest single-day decline in precious metals since the Hunt Brothers crisis of 1980. But why call it a crime scene? Because of the discrepancy. While the paper price on the COMEX was crashing to $78, the spot price of physical silver held at $85. That $7 gap is the smoking gun. It proves that the sell-off was not driven by people selling actual metal. No one was lining up at a refinery to sell their silver bars for 30% less than they paid yesterday. It was driven by the liquidation of paper contracts. Bets on the price of silver that have no physical backing. The crash erased weeks of gains. It wiped out the late longs, the retail investors who had bought in at the top, driven by FOMO, fear of missing out. But who was on the other side of the trade? Who was buying when everyone else was forced to sell? The smart money. They used the 30-minute window to acquire positions at a massive discount, clearing the board of speculative leverage so they could accumulate assets for the next phase of the bull market. This was a controlled demolition of the retail investor executed with algorithmic precision. The crash didn't happen in a vacuum. It was triggered by a specific mechanism, the CME Margin Trap. The CME Group, which runs the COMEX Futures Exchange, is the referee of the precious metals market. And on Friday, the referee decided to change the rules in the middle of the game. At 2 p.m. on Friday, coinciding perfectly with the start of the crash, the CME announced an emergency hike in maintenance margin requirements. They raised the margin for gold by 33%. They raised the margin for silver by a crushing 36%. Effective today, Monday, February 2nd. Let me explain why this is a trap. Margin is the collateral you must post to hold a futures contract. If you buy a silver contract worth $375,000, you might only need to put down $25,000 in cash. That is leverage. By raising the requirement, the CME forced every trader holding a position to come up with thousands of dollars in extra cash over the weekend. If they couldn't come up with the cash, their broker automatically liquidated their position on Friday afternoon. This created a forced selling loop. The margin hike announcement caused selling. The selling caused prices to drop. The price drop triggered more margin calls, which caused more selling. It was a mechanical cascade. But there's a deeper layer to this trap. Earlier in January, the CME had quietly shifted to a percentage-based margin system for silver. Under the old system, margin was a fixed dollar amount. Under the new system, margin is calculated as 9% of the contract value. This meant that as silver prices rose to $120, the margin requirement exploded exponentially. The cost to hold a position doubled as the price doubled. This dynamic trap ensured that the higher silver went, the more capital was drained from the system to maintain the same number of contracts. The market became capital-starved. It had no buffer. So when the margin hike hit on Friday, there was no liquidity left to absorb the shock. The market collapsed because it had been mathematically engineered to be fragile. The CME calls this risk management. We call it a kill switch. It successfully flushed the leverage out of the system, resetting the open interest to levels that the bullion banks could manage. If the margin hike was the weapon, the trigger was political. The catalyst for the Monday reset came from the White House with the nomination of Kevin Warsh as the next chairman of the Federal Reserve. This is the worst shockwave. For months, the market had been pricing in a dovish. Federal investors believed that interest rates would be cut aggressively in 2026 to save the economy from recession. Low interest rates are rocket fuel for gold and silver, which pay no yield. But Kevin Warsh is not a dove. He is a hawk. A former Fed governor, Warsh is known as a disciplined defender of the US dollar. He believes in sound money, but his version of sound money is a strong dollar, not high gold prices. His nomination sent a clear signal to the global bond market. The era of easy money is over. The reaction was instantaneous. The US dollar index DXY spiked. Treasury yields surged across the curve. The real yield, the return on bonds after inflation, expanded. Mathematically, when real yields rise, gold and silver fall. Institutional algorithms raid the headlines. Warsh nominated. They calculated the probability of rate cuts dropping to zero, and they dumped precious metals to buy dollars and bonds. This was a macro repricing. The market had to undo months of betting on rate cuts in a single afternoon. This shock wave effectively ended the liquidity-driven rally that had pushed Bitcoin to $87,000 and gold to $5,600. Warsh represents a new regime. A regime where the Federal Reserve will sacrifice asset prices, stocks, crypto, gold to save the credibility of the currency. This is why we call it the Monday reset. We are resetting from a reflation trade, betting on printing money, to a hard money trade, betting on a scarce dollar. For the precious metals investor, this is a dangerous transition. It means the wind that was at your back is now in your face. But it also exposes the fragility of the entire system. Because if the Fed truly tightens, the $35 trillion debt pile becomes unpayable. While the West focuses on the Fed, the real engine of the chaos is spinning out of control in the East. We must talk about Japan. The Monday reset is inextricably linked to the Japan debt spiral. Japan has the highest debt to GDP ratio in the developed world for decades. They kept interest rates at zero to service this debt. But as the US moves toward a hawkish stance under Warsh, the gap between US rates and Japanese rates is widening to a breaking point. This forces the Japanese yen to crash. To save the yen, Japan must sell assets. On Friday, Japanese investors, who are the largest foreign holders of US debt, began liquidating positions to bring cash home. This repatriation of capital creates a liquidity vacuum in global markets. But here's the twist. Japanese investors aren't just buying yen. They are buying physical gold and silver. In Tokyo, the price of physical metal has disconnected from the global paper price. While COMEX silver crashed to $78, retail buyers in Japan were paying premiums equivalent to $130 per ounce. Why? Because they don't trust their bond market. They see the debt spiral where the government must print money to pay the interest on the money it already printed. This creates a localized flight to safety that completely contradicts the paper crash in New York. The Monday reset is a tale of two markets. In the paper market, prices are falling because of margin and rates. In the physical market, prices are rising because of fear and scarcity. Japan is the canary in the coal mine. It shows us what happens when a sovereign debt market breaks. The paper price becomes irrelevant, and the physical price becomes the only lifeline. The contagion from Tokyo is what made the 30-minute crime scene global. It wasn't just New York selling. It was Tokyo panicking. This brings us to the most critical pillar of the reset, the Great Divergence. For 50 years, the price of gold and silver has been determined by the futures market, by paper. Traders trade contracts representing millions of ounces that do not exist. But today, on February 2nd, 2026, the paper market and the physical market are filing for divorce. Let's look at the fundamentals of silver. Silver is no longer just a monetary metal. It is a strategic industrial green metal. You cannot build a high-efficiency solar panel, topkin, or hat without silver paste. You cannot build an electric vehicle without silver contacts. You cannot run an AI data center without silver-coated connectors. The demand is inelastic. Apple, Tesla, and Samsung need silver regardless of the price. According to the Silver Institute, the structural deficit for 2026 is projected to be nearly 200 million ounces. We are in the sixth consecutive year of deficit. The above-ground stockpiles are being drained. Yet the paper price crashed 30% on Friday. This creates a delivery crunch. If you are an industrial user looking at the screen price of $78, you think, great, I'll buy. But when you call the refinery, they say, Sorry, we have no metal at that price. The real price is $95. This is the divergence. The paper market is being driven by interest rates and margin calls. The physical market is being driven by industrial necessity. To get the Monday reset is the realization that the paper market can no longer dictate the physical reality. Eastern markets led by the Shanghai Gold Exchange are draining physical inventory from the West. Inventory data from the COMEX shows stocks rising slightly, but this is a mirage. It is precautionary stockpiling by banks who know a squeeze is coming. Meanwhile, in China, inventories have declined by over 1/200 tons. The paper price is a tool of misdirection. It scares retail investors into selling their physical coins, which the whales then scoop up at a discount. The crash was necessary to prevent a total breakdown of the delivery system. If prices had stayed at $120, the demand for delivery would have broken the COMEX. By smashing the price, they bought time. But they did not solve the shortage. So, who benefited from the chaos? Who was buying when you were panic selling? This brings us to the exit door strategy. This is the tactical behavior of institutional whales during the crash. They knew the worst nomination was coming. They knew the margin hikes were coming. So, they implemented a strategy to exit their paper longs and enter physical ownership. On-chain data from crypto markets and warehouse reports from bullion vaults show a massive movement of assets into cold storage over the weekend. Binance, the crypto giant, moved nearly $1 billion into secure wallets during the crash. Bullion dealers reported record sales volumes on Saturday and Sunday, even as the markets were closed. This is the institutional handover. The smart money used the 30-minute crime scene to transfer wealth from the weak hands, leveraged retail traders, to the strong hands, unleveraged institutions. They use the exit door of the futures market to enter the vault door of physical ownership. They know that in a high-interest rate environment, paper assets are vulnerable, but physical assets, what we call world's treasury assets, are immune to counterparty risk. The January flush served to clear the market of speculators. Now, as we start the Monday reset, the market is cleaner. The leverage is gone. The price may be lower, but the foundation is stronger. The $5.9 trillion that vanished didn't disappear. It was the premium of speculation evaporating. What remains is the bedrock value of the asset. And the institutions are now sitting on that bedrock, waiting for the industrial shortage to drive the price back up, this time on their terms. There is a psychological dimension to today, February 2nd. In the trading community, Monday reset has become a mantra. It is a rejection of the chaos of the weekend. It is a return to structure. After the FTX-like pain of Friday, where extreme fear gripped the market, the fear and greed index hit 16. Traders are using today to brain dump their losses and start fresh. This is crucial. The market cannot go straight down forever. Psychology dictates that after a massive flush, there is a period of stabilization. The Monday reset is that stabilization. It is the deep breath after the panic attack. It allows the market to look at the data again, to look at the deficits, to look at the debt, and to realize that nothing fundamental has changed. The dollar is still being debased in the long run. The debt is still unpayable. The silver is still running out. The crash was a temporal landmark, a moment in time that separates the mania of January from the reality of February. It was a painful lesson in the dangers of leverage, but for the disciplined investor, it was a gift. So, where do we stand on this Monday morning? The price of silver is $78. Gold is $4,145. To the uneducated eye, the bull market is over. The bubble has burst. But to the historian, this is simply the Monday reset. It is the moment the system purged its excesses so it could survive the next leg of the journey. The 30-minute crime scene was a brutal transfer of wealth. The CME Margin Trap was a regulatory weapon. The war shock wave was a political pivot. But none of these things created an ounce of silver. None of them solved the Japanese debt crisis. None of them fixed the US deficit. The paper price has been reset. The physical reality has not. If you hold physical metal, today is just another day. You still hold the same number of ounces. If you hold paper, you have learned a hard lesson about the rules of the casino. The exit door is still open, but it is narrowing. The smart money has already walked through it, swapping their contracts for bars. The question is, will you follow them? Secure your coins. Secure your future. Because the next time the market resets, it might not be a price crash. It might be a delivery failure. And on that day, the paper price will be zero and the physical price will be infinity. I am the financial coin historian. The reset is complete. The new game begins now. Stay watching.